Welcome into the Invest with Dubs channel, where we focus on long-term investing. So if you're interested in day trading, swing trading, catching the next meme stock that's going up 600% in one day, go ahead and just turn off. This channel is not going to be for you. So for this video, we're going to be starting a video series on the types of long-term investing strategies. The goal of this is to help you guys learn about different long-term investing strategies, understand what they comprise of, what are the potential benefits and risks, and learn about what if I had to follow this strategy, how would I follow it? So for this first one to kick it off, we're going to be looking at the S&P 500 only long-term investing strategy. So within this video, we'll be talking about what the S&P 500 is. We'll cover what an ETF is. We'll cover a couple of definitions of things to look at when comparing ETFs. We'll look at a couple of examples of S&P 500 ETFs. We'll look at what's the benefit of this strategy, what are some risks, and then finally, I'll give my opinion on if I were to follow this strategy, what ETF would I choose and why? All right, so to level set, first let's start with the obvious of any long-term investment strategy. The most important thing to do is to be consistent. So the way you're going to have compounded work for you is if you're always contributing to your investments and always add in more so that way it can grow over time. And especially when you're investing in an ETF such as the S&P 500, you don't have to do much work in regards to analyzing a specific company, reviewing their earnings, and projecting out what their future stock price could be. With the S&P 500 ETF only strategy, it's really just about being consistent. So whether you're able to invest weekly, bi-weekly, or monthly, always being able to stay consistent with that is going to be how you capitalize on this sort of approach. So John Templeton had a famous quote that said, "The best time to invest is when you have money." And especially when you're following a long-term approach, such as buying ETFs only, this is a perfect definition to follow because there's no point to try to time it. You're really going to make the most out of it the more your money has time to work for you. Let's first level set for anyone that's brand new to the market. If you already know this, feel free to skip ahead a little bit, but the S&P 500. What is the S&P 500? This is what people refer to as the market. When you're trying to consider if you're going to beat the market, perform in line with the market, people are referring to the S&P 500. It covers approximately 80% of the market cap. And really, this is weighted by market cap. So it'll look at the top 500 largest US companies and it's spread across many sectors. And like I mentioned at the start, it's viewed as the benchmark. Going to the next one. So an ETF, for anyone that doesn't know what an ETF is, what is it? So an ETF and mutual funds, they're both offering diversified pooled investments. Now, the difference when you're comparing these two types is an ETF trades all day. Mutual funds only trade once a day. An ETF is also going to be a lot lower of an expense ratio. So essentially, it'll cost you less to hold an ETF versus holding a mutual fund. And ETFs are generally more tax efficient. So when comparing between the two, ultimately, it's in my opinion that you should choose an ETF over a mutual fund, mainly just due to them being lower cost. So looking at three of the most popular S&P 500 ETFs, so all of these are going to track the S&P 500, and as you can see, they all have fairly low expense ratios, oftentimes it being around 0.03%. So with S&P ETFs, that's going to be one of the main perks of them is they do have low expense ratios. Now, for our examples of ones to compare, we're going to look at these three that are by Vanguard. So they're all three of them are S&P 500 ETFs, but they're done a little bit different. So you have VOOG, which has about 500 stocks in it, so it's really closely tracking exactly with the S&P 500. Then you have VOOG, which is more of the S&P 500 growth ETF. For this one, they're going to be tracking only about 140 stocks, so it's going to be a lot more concentrated. So not necessarily tracking the full exposure of the S&P. And then finally, you'll have the S&P 500 value one, which tracks about 450 stocks in the ETF. So let's dive a little bit more into comparing these three so we can kind of understand what's the benefits and what's, the negatives of each of these. So if we're looking at the three of these, so the top 10 holdings, both VOO and VOOG, which is the growth one, have very similar top 10 holdings. Now, the only difference you're going to see is what percent of those total net assets does it make up. So when you're looking at VOOG, they're going to have a lot higher concentration in those top 10. So those top 10 stocks make up almost 60% of their total net assets, which could be a positive, but it also could be a negative because you're going to be a lot more at risk for those top 10 stocks either flatline or go down, then that will likely underperform. Versus VOO is only at about a little over a third of the total net assets does the top 10 make. And then if you look over at the value one, it's even lower than that. So they're spreading out a lot more. And they're also pulling forward a handful of different stocks. Now, if we're looking again at these three, the next thing to compare would be the expense ratios because you could look at one fund that you might like better, but if the expense ratio is a lot higher, sometimes in the long run, it actually pulls down the gains to a large degree where it ends up being worse. But as you can see, all three of these are fairly low. So the growth and value funds are about double the expense ratio, but they're still, all three of them are under 0.1%, which is extremely low. Now let's look at the important stuff. So let's look at what their past performance has been. So these performances are after the expense ratio has been removed already. Let's focus in on, since we're on the long term, let's focus on the 10-year line. So if you see VOO and VOOG are both over 14%, and then the value ETF has largely underperformed the two in 10 years, down at 11%. When you're trying to compare ETFs, what are the things that would be good to compare? So just as we went through, look at the number of holdings to see how diversified the funds are. Look at what's the top 10 holdings, so what companies are make up the largest chunk of the ETF, and also what percent of those top 10 does it make up for the entire net assets, so you can see how concentrated they are. Then look at the expense ratio. How much is it going to cost you to hold that ETF each and every year? Finally, let's go ahead and look at the past performance because ultimately we want to get the greatest return in the long run. Looking at the benefits of an S&P 500 only strategy is one, you're going to get low volatility. Since you're going to perform in line with the market, you're not going to have as large as swings to the upside or the downside. The S&P 500 has been around for a very long time. You got 65 plus years of a proven track record. This is probably going to be as close to what you would consider passive income wealth building by holding the S&P 500. You're going to have very low expense ratios and you're going to be very diversified. You're going to have about 500 different stocks just by holding this one ETF. And this will really allow you to stay as disengaged with the market as possible. You'll be able to just focus on anything else in your life while the S&P 500 goes ahead and works for you. Now, what are the risks of only doing an S&P 500 strategy approach? So the first one is there's going to be limited upside. You're going to perform in line with the market. You'll never feel like you, in quotes, beat the market. You'll often be disengaged with the market, industries, and companies because you're just buying an ETF. You're not spending the time to review certain companies, review their earnings, really follow up on, like, say, CNBC News, see what's happening in different industries. As a result, you'll also have reduced knowledge on the market and industries and companies, and it will be almost impossible to exceed 20% CAGR long term. So really the risk of becoming complacent is the missed alpha opportunities that you could if you pursued a different strategy. If I was following this strategy, which S&P 500 ETF would I choose? Well, the answer to that is I would choose VOO. And that was, as a reminder, this was the one that held about 500 holdings. It's very closely aligned with the S&P 500. And the reason I would choose this one is because if I was following an S&P only strategy, then my intent would be to be disengaged kind of from the market, make it as passive as possible. I'd probably want to make auto payments into my investment account and have auto buy set to consistently buy VOOG. So I wasn't spending time buying this. A lot of my time then could be just focused on my individual career growth, spending time with my family, and doing whatever else, and just keeping my investments to something passive. Now, the thing that everyone is probably most interested in, if I were to follow the S&P 500 only approach, please let me know how much could I expect to make. All right, so let's run that scenario if you had the exact question. Let's start with a very modest scenario. Initial investment, you're only putting in $1,000. You're contributing monthly an additional $500. And let's look at 40 years, because if you're following this strategy, this is a really like set it and forget it kind of strategy where you start as soon as possible and wait until you're done with your career and you're getting ready to retire. So that's why we do 40 years here. For estimated interest, let's look between down at 8% to 11%, and we'll have at the upper bounds 14%. But if you're doing the S&P 500, I would not count on getting 14%, likely somewhere between the 8 and 11%. So after 40 years of doing this, you could expect anywhere from on the low end $1.5 million to the 11% range. That gets you $3.5 million. So that's still a good chunk of change right there to have. And just to go back one slide, remember these were very modest numbers. So this doesn't take into account, 5 years, 10 years later, if you get a promotion at your job and now you can invest double this money, or initially if you were able to put in a larger deposit. If you could do any two of those, you're going to have a lot higher number than you're seeing here. So again, very modest scenario, and you're ending up a multimillionaire by the time you retire. As we look ahead to what's left in this series, so we just covered the S&P 500 only approach for the long-term investment strategy. Next week, we'll look at the NASDAQ 100 only ETF strategy. And then in future videos, we'll look at what if we mix the ETFs, what if we mix ETFs with individual stocks, and then what if we only did individual stocks. And then finally, we'll recap all five of these approaches, and I'll discuss the approach that I am personally using and why I chose to use that. All right, that's all for this video. Thanks for watching, guys. Don't forget to smash that like button down below. Make sure to hit subscribe so you see when these new videos and the rest of the long-term investing strategy series release. And comment down below, what are your thoughts on this approach? Does this align with your values? And how would you like to invest? Or do you think you would prefer a different method for long-term investing? Let me know in the comments down below, and we'll see you in the next one. Thanks. Peace.